Good afternoon. Good afternoon. It's Monday, the 4th of August. Welcome to another edition of Monday Market Picks. My name is Silan Wickramasinghe, the head of research at Maybank Securities. The STI has finally had some momentum coming back after about 6 days of a losing streak. I think the Trump tariff love letters, they've pretty much arrived for everyone. So there is some calm that is coming to the market. Singapore is actually standing out pretty well with a 10% base rate. So that's actually good news for supply chains moving, and Singapore will get some preference there. And also some more momentum for the domestic market from all the other domestic factors like the construction boom, capital returns, and so on, also coming to stage as well. So that's what we're going to be focusing on today. We are really going to be focusing on stock picking and picking some winners. So we'll have Hussaini, who will be talking to us about the latest numbers from Siong, and also a very interesting report on self-driving cars. The future is actually a lot closer than you think, and how that's going to have a big impact on Grab. And then we're going to talk about airlines. We got a big sell call last week from Eric on SIA, and we got a new initiation on Thai Airways with a buy. And Bunyakorn is joining us from Thailand to explain why, as the stock returns for trading after a 5-year hiatus. And then I'm going to talk a little bit about OCBC and why I'm not particularly impressed with their results last Friday. And also we'll have some brand new trading buys from our chart guy as well. So let's jump into the show and let's have Hussaini coming on stream first. Now, Hussaini, Sheng Siong reported their second quarter results last week, and it seems like profit growth is slowing a little bit. Is that a concern, and how do you see your buy call from here?
Yeah, sure. Thanks, Thilan, for having me. Agree that the net profit of Sheng Siong of just 2% year on year was soft, but operationally, they were strong with revenues up 7% year on year and gross profits up 9%. They had been adding record new stores, and there is an equally strong pipeline going forward. Now, the slower net profit growth was mainly owing to higher staff costs and costs linked to new store openings. This should normalize in second half of 2025, and as the staff costs were mainly raised in the first half of 2024. So we expect to see normalization going forward in the second half, and as the new store sales ramps up. As such, we expect the above trend growth for Sheng Siong going forward, and it is also linked to the competitor rationalization, i.e. rationalization by Giant. We maintain our buy on Sheng Siong.
Okay. Let me change and talk about Grab here. I mean, Grab also reported their second quarter numbers, and they actually look pretty strong. What are your key takeaways from the Grab numbers, and what's driving your continued buy call here?
Yes, see, for Grab, the growth was quite strong. So the GMV growth was 21% year on year, and this was the strongest growth since we had seen since COVID. Okay, now and at the same time, the fintech business was also equally strong, with the loan book grew more than 70% year on year, and company has guided that it will remain strong going for the second half of this year as well. Now, despite the strong GMV growth, stock came off by almost 10% since the results last week, and that is linked to the fact that the incentives grew a little bit more, and as a result, EBITDA margins came off by 10 to 20 bips. So that was one investor worry, that the incentives were up, resulting in stock correction. We are of the view that it is quite seasonal in nature, this incentive increase. If we see the second quarter of last year as well, similarly, we had seen this incentive increase. Going forward, we expect incentives to come off, and as such, a strong EBITDA to reappear. and management as well is guiding the same. So we remain quite comfortable and maintain our buy on Grab.
Okay, so now let me shift gears and talk about autonomous vehicles or self-driving cars. It seems like the technology has advanced enough to get to commercialization soon. Is that assessment correct? And what are the different and promising technologies out there? I mean, I know a lot of our viewers are very interested in Tesla as well. So what is happening in that space?
Yeah, sure. So yeah, means to start with, if we look into the Grab's post earnings call last week, it was to an extent also dominated by the discussion on autonomous vehicle, self-driving car, and what Grab is doing into that. Now going to the question, autonomous vehicles or self-driving cars are already commercial, and in few of the global examples are Waymo in US or Apollo Go in China and in Middle East. So if you are in US or in Middle East, you can order autonomous vehicle. Now, having said that, the commercial operations are in place. Although the commercial operations are in place, unit economics are still not favorable. So, for instance, human-driven Uber cost per mile is less than 2 USD in US, whereas the cost for Waymo is more than 3 USD per mile. And why Waymo's costs are higher? It is linked to expensive technology costs or hardware costs like LiDAR, radar, sensors, compute. All this jacks up the cost for Waymo, resulting in higher cost per mile. Also, the expensive R&D costs as well. Now, with any technology, uh, or any technological innovation and commercialization, this cost should come down. And there are some technologies in place, like as you said, that Tesla's vision-driven FSD, as well as Baidu's Apollo Go. So these technologies are vision-based and likely to bring the cost more than 60% down. And with that, the unit economics will be much more in favorable for autonomous vehicles. In Southeast Asia, Grab is taking the lead. They have multiple trials are in place. They have multiple technology partnerships. So we are of the view that they are most likely to be the first to deploy autonomous vehicles in this part of the world.
Okay. So, I mean, from that point of view, what is the sort of earnings impact, at least the future earnings impact to Grab on this? And will this technology be, permeating across Southeast Asia, or will it be more focused on Singapore?
Yeah, sure. So, although it is too early to gauge the impact, but in our blue sky scenario, we estimate an annual savings of 70 million USD for Grab, assuming that the costs come down by 50-60%, the technology cost, and around 20% of its Singapore rights goes to autonomous vehicles. And this technology roadmap, to an extent, is very clear with the commercialization of vision-based technology. So, assuming that, we estimate that Grab could have 70 million in cost savings, and that translate to around 7% lift in Grab's NPV. Now, outside of Singapore, in other emerging ASEAN markets, we see that the scope is relatively limited. And the key reason is that first, the road infrastructure is not as sophisticated as it is in Singapore. And the second part is that there will be a risk of labor displacement. So that factor also will come in the way of commercializing autonomous vehicles in other parts of the world or in other parts of ASEAN. But Singapore opportunity itself is quite big, and there will also be opportunities in the space of food delivery using autonomous bots or something like that.
Got it. Now, let's talk about ComfortDelGro as well. I mean, that's one of the biggest market share leaders in Singapore when it comes to taxis. Will AVs disrupt their model, or will they actually benefit as well?
No, we don't think that AVs are going to disrupt their model. See, bit of the operational details is that AV will have three parts. First is technology, AV technology. Second is the platform, and the third is the fleet operations and maintenance. Someone has to operate the fleet, right? In the current scenario, which is the platform model like Grab, the fleet is maintained and operated by drivers. But in the driverless world, someone has to do that. And that's where Comfort Delgado could come in. Comfort as well as taken early steps in the space. They have established a 30 million autonomous vehicle center of excellence. They as well have partnered with multiple technology providers like Movita and Pony.ai, and they as well are doing multiple trials in Singapore as well as in China. In our view, Comfort will be a beneficiary given driver shortages in Singapore, and a similar favorable unit economics as we discussed for Grab also applies to Comfort. So they will be a beneficiary in our view.
There's a very quick question from the audience from Cyprus who's asking on autonomous driving. May I know if the cost per mile estimate is inclusive of the vehicle cost? And if so, how much as a percentage do you know the breakup of the vehicle cost versus compute? Any rough idea, Husseini?
Yeah, so the number we gave, $2 per mile for Uber and more than $3 per mile for Waymo, it is inclusive of the vehicle cost. And to give the breakdown, and we have that discussion in the report, in the US, the car cost is somewhere around 70,000 USD, but the technology cost is 100,000 USD. So the technology cost is much bigger. And on top of the technology cost, this is the hardware cost we are talking about: lidar, radar, sensors, compute in the car. That's 100,000 USD. If you put the R&D cost on top of that, that will be the additional cost.
Got it. Okay, thanks, Hosseini, for that. And let's turn to airlines. Now, last week, Eric downgraded Singapore Airlines to a sell after their big second quarter miss, as well as the weakening outlook in terms of the cost environment. Today, we have Thai Airways resuming trading after about a 5-year break after they're emerging from their debt restructuring. So we've got Bunyakorn online. Bunyakorn, welcome to the show. You've reinitiated on Thai Airways with a buy rating and a big 10 baht target price. So maybe before we go into your buy call, can you catch us up on what's been happening over the last 5 years?
Hi, everyone. So I think today is the first day that after 5 years of suspension that we came back for trading. So if you look back in 2020, it was a COVID time, but even before the COVID time, Thai also experienced significant financial losses even before the COVID pandemic happened. So it was attributed to high operation costs, also the inefficient procurement system, high employee numbers, and also a diverse fleet. We used to have 9 type of engines. As of now, we have reduced by almost 40% to about 6 type of engine, and we're looking to change it to only 5 type of engines. So and airline also the business also entering business rehab time. Post rehab, most of the issue have been resolved. While we are seeing clear management effort to continue to transform this organization into an airline with a high operational efficiency. So this was the evident in 2024 financial result, where is able to maintain yield, passenger yield, and also comparing to regional peers, and also the cost that has been cutting by almost in half. Yeah.
Got it. So now what's driving your buy call? and the big target price?
Okay, so our earning growth, we not expect to see earning growth in the upcoming 3 years. But the thing is, the cash flow is very strong. I mean, comparing to other Thai stock that be trading at cash flow CFO to market cap at about 4 times. That's probably a 55 billion baht of cash and generate per year. We like it because of our cash flow generation and so opportunity to pay dividend. If we peg our target price at 10 baht, right? You could be about 7 to 8% if they decide to raise the payout to 75% to 100% of annual profit. The third thing we like about the Thai Airways is because of the first 6 months, we have only 6.7% free float. So there will be a lot of demand, but less supply of shares to be traded.
Got it. And how should you think about regional competition? I mean, you got SIA and all the other regional players also in there, and you got the super carriers from the Middle East. So how should we think about regional competition and Thai Airways?
Okay, so competition is increasing along with the supply of new delivery of new aircraft from major manufacturer like Boeing and Airbus. But the thing is, passenger yield, which is revenue divided by the capacity, right, is going down. But the thing is, Thai has been proving that in the past 2 years, yield has been declining at a slower pace than other peers. It's mainly due to they have a better strategic location. We have 20 hours, 12-hour flight, direct flight from Thailand to Europe. That's competing with other Middle Eastern airline that they have to stop at the midway, and then they can offer at a lower price. But the thing is, our is a bit of premium product, which is a direct flight, 12 hours. We still have to fill up the plane with the 80% of load factor without any price competition. So we expect the competition for us to not highly compete with other regional airlines.
Got it. And any downside risks that we should worry about in the near term?
Okay, one of the key concern is Thai was SOE. It's a state-owned enterprise. We used to incur a lot of employee benefit, overpaying maintenance costs. I think as of now, Thais have about 39% stake belong to Ministry of Finance. So after the lockup period, right, which is gonna last for from today until February, right? If MOF decide to buy shares above 51%, right? That could be the status of the company could be go back to SOE, and that could be some of the decision by the management could be interfered by Ministry of Finance, which is that's the key risk that the investor are concerning.
Great. Bunyakan, thank you so much for joining us. Now, let's turn to OCBC, who reported their second quarter numbers last Friday. First, the earnings were in line, but growth is softening. Net interest income was down about 6% year on year. We saw a big pullback in net interest margins, and loan growth wasn't good enough to cover that. The good news, though, is that asset quality is solid. NPLs are steady at about 0.9%, and credit costs are actually trending lower. So I think that'll support stability. Now, the third point I want to make is that the capital returns from OCBC is uncertain. They spent about 1.4 billion on Great Eastern, trying to take them private. But the reality is, after all that, the EPS accretion to OCBC is less than 1%. If they actually took that 1.4 billion and gave it back to shareholders, that would have actually added about 2% dividend yield, which would actually be in the high sevens to close to 8%. So we are not very, very sure what OCBC is planning on doing with capital returns. So we've raised the target price slightly, but that's mostly from rolling forward valuation models. But I think we're comfortable just keeping this company as a whole, because a lot of clarity in terms of capital returns will depend on the CEO, the new CEO, who will only step in January next year. There's a lot of growth factors though, like wealth management, China turning around, a lot of synergies in the one OCBC execution, but a lot of that are still developing. So we are comfortable with our whole rating there. Now, just a quick take on CapitaLand Ascott Trust, which Krishna is maintaining a buy. They've just completed a major Tokyo asset divestment. They're divesting the freehold citadines, Central Shinjuku Tokyo property for 100% premium to book, with an exit EBITDA yield of 3.2%, unlocked about 51 million of net gains. That's going to help them pay down some of their debt, and it's DPU accretive by about 1% or so. The Shinjuku property was pretty old and dated, so it needed significant capex. So it now will get recycled into higher growth living sectors in Tokyo. Management is keeping a fairly stable DPU outlook, so we are maintaining a buy call there. Now, just to quickly look at what our chart guy is saying, we've got two key stocks there, UOBK here, which has had a pretty strong run, but it's come off a little bit in the last, it's had about a decline of about 4 consecutive days after a very bullish run. But our chart guy says that there's fresh buying interest emerging from there. So do look at that chart and his write-up in our newsletter today. The second one is CENTURION. The stock's current sideways movement is narrowing as it trades within a tightening triangle pattern. So that will also help it move higher going forward. With that, let's just have a look at upcoming events. There's this event that you can't afford to miss, which is on the 13th of August, where I'll be speaking to the chief economist of NASDAQ, Phil McIntosh, who's going to talk us through all what he thinks is happening with the Trump tariffs, as well as a lot of the US political uncertainties and how that's all going to play out. This is a 1 hour talk that you can't afford to miss if you're interested in what's happening in the US and also what's happening generally in the Southeast Asian region as well. So, because I'm going to be making sure he talks about that as well. So that's at 1 p.m. on the 13th of August. So if you haven't signed up, do that with scanning the QR code here. With that, unfortunately, that's all the time we have today. Thank you so much for joining us. Have a profitable trading week, and we'll see you next week.